Welcome aware, onda dumalang mola sa buona hukandad, and a warm welcome to the Indubo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Namuzi Rico Amba, a lekker discussion. Today, we're diving deep into a topic that might sound a bit like a snooze fest at first, International Accounting Standard 20, or IAS 20 for short. But trust me, fam, this one's surprisingly relevant to understanding how businesses and even our economy here in South Africa really tick.
You know how we always hear about those government grants and assistance programs, especially for businesses? Well, IAS 20 is like the rule book for how companies should be recording all that in their financial statements.
It's kind of like peeking behind the curtain to see how the magic happens.
Exactly. And because it's an international standard, our South African businesses are playing on the same field as the big global players.
Okay, let's unpack this. First things first. What exactly is IAS 20 in plain English?
Think of it like a set of guidelines issued by the International Accounting Standards Board. It tells companies how they should be keeping track of and reporting things like government grants and assistance in their financial statements. It's all about transparency and making sure everyone is playing by the same rules.
So like if a company in Josie gets a grant, they have to report it the same way a company in London would.
Spot on. And that's important because it allows investors, analysts, and even us regular folks to compare how companies are doing, both here at home and internationally.
That makes sense. But let's get down to the nitty-gritty. IAS 20 throws around terms like government grants and government assistance a lot. Can we break those down in a way that makes sense for us, Safas?
Sure. Government grants are basically transfers of resources, often money, to an entity. It could be a business, a nonprofit, even a community project. But these transfers come with strings attached. Certain conditions the entity needs to meet.
So it's not just free money falling from the sky. There's an expectation of something in return.
Right. For example, think of a grant for a spaza shop owner to expand their business in a township, or funding for a young entrepreneur to start a tech company. These are grants designed to support specific goals.
So it's like a helping hand, but with a purpose.
Precisely. Now, government assistance is a broader term. It includes things that might not be direct cash transfers. Think of free mentorship programs for small businesses or tax breaks for companies investing in renewable energy.
So it's more about the government giving a boost in different ways, not just dishing out cash.
You got it. And IAS 20 helps keep track of all of this.
All right, that clarifies things a bit. But how do companies know when to actually record these grants in their books? When can they officially say, hey, this grant is ours?
IAS 20 has some specific criteria for that. First, there has to be reasonable assurance that the entity will actually meet all the conditions attached to the grant. No funny business.
So no claiming a grant for a solar panel installation and then using the money to buy a new sound system.
Exactly. And secondly, there needs to be reasonable assurance that the grant will actually be received. No counting your chickens before they hatch, as they say.
So it's not enough to just apply for a grant. You need to be pretty sure you'll tick all the boxes and actually get the money.
Right, again. And whether that grant comes as cold, hard cash or maybe as a reduction of a liability, it all gets accounted for the same way. But the interesting part is how companies actually account for these grants once they've cleared all those hurdles.
Now we're getting to the real meat of the matter. Tell me more.
Well, there are two main approaches, the capital approach and the income approach. And believe it or not, there's actually quite a bit of debate about which one is better.
Ooh, controversy. I'm all ears.
So with the capital approach, the grant is seen as a financing tool. Instead of going straight to the profit and loss statement, it's treated like a loan that doesn't need to be paid back and sits on the balance sheet.
So it's like saying, thanks for the boost, government.
Yeah.
But we're not counting this as straight up profit just yet.
Precisely. Now, the income approach is a different kettle of fish. Here, the grant is recognized as income over time, but it has to match the periods where the company is actually spending money related to the grant. The idea is that the company is, in a way, earning the grant by fulfilling its obligations.
So it's more about aligning the grant with the activities meant to support, spreading the impact over time.
Exactly. And there are strong arguments for both approaches.
I'm dying to know what those arguments are. Spill the tea.
Well, those who love the capital approach say that grants are basically a financial boost, not something a company earned through its day-to-day operations. They think it's more transparent, to keep it separate from the profit and loss statement.
Like saying, this is a nice bonus from the government, but it's not part of our core business earnings. Gotcha. What about the other side?
The income approach fans argue that grants are rarely ever truly free. The company has to jump through hoops, meet those conditions we talked about, and deliver on promises, so they believe it makes more sense to recognize that income as the company fulfills those obligations.
That makes sense too. It's like acknowledging the effort and commitment involved.
Right. And IAS 20 actually picks a side in this debate, landing firmly on the side of the income approach. The standard emphasizes that grants should be recognized systematically over time, matching the expenses they're meant to cover.
So it's all about that matching principle.
Hmm.
But I'm guessing things aren't always so clear-cut. What about those non-monetary grants?
Yeah.
Like when the government gives a company land or resources. How does that work?
That's where things get a bit more complex. Let's dive into that in the next part.
Sounds good. Let's take a quick breather and come back to unravel this whole non-monetary grant mystery.
All right, let's tackle those non-monetary grants. Imagine the government decides to give a company a piece of land in a special economic zone to build a factory. That land is valuable, but how do you put a number on it?
That's a good question. It's not like they can just walk into a supermarket and check the price tag on a piece of land.
Exactly. So IAS 20 says these non-monetary grants should be valued at their fair value, what the asset would sell for in an open market.
So they'd have to bring in a property expert to assess the land's market value.
Spot on. And then both the grant and the asset are recorded on the company's books at that fair value.
Makes sense. But I imagine figuring out fair value can be tricky sometimes. What if the land has some unique features or is in a remote location?
You're absolutely right. It can get tricky, especially with specialized assets. There's a lot of judgment involved.
And I bet there are cases where it's almost impossible to determine a reliable fair value.
You're reading my mind. And IAS 20 acknowledges that. It allows for an alternative treatment where the asset and the grant are recorded at a nominal amount. Basically, a tiny symbolic value.
So it's like saying, we know this thing has value, but we can't put an exact number on it, so we'll just record it for a small amount.
Exactly. It's a practical solution for those tricky situations.
Practical solutions, always a good thing in accounting. But let's shift gears a bit. We've talked about recognizing grants, but how do they actually show up in those financial statements?
When it comes to grants related to assets, there are two main options. You can either show it as deferred income or deduct it from the carrying amount of the asset.
Okay, so two different ways of presenting the same thing. Can you break that down for us?
Of course, with the deferred income approach, you basically create a liability on the balance sheet. It represents the future income. That will be recognized as the grant is amortized over the life of the asset.
So it's like saying, we've got this future benefit coming our way, but we're going to spread it out over time.
Precisely. Now, the other option is to deduct the grant from the carrying amount of the asset. For example, let's say a company gets a R1 million grant to buy a machine. That also costs R1 million. They can actually show the machine on their books at a net value of 0.
Wow, that's interesting. So you're immediately reflecting the impact of the grant on the value of the asset.
Right. And then over the life of the asset, the company would have lower depreciation expense because the carrying amount is lower.
So both methods ultimately have the same impact on profit over the life of the asset.
Yeah.
Just different types.
You've got it. It's all about presenting the information in a way that's clear and understandable.
Clarity and understandability. Music to my ears. But IAS 20 isn't just about pretty presentations. It also deals with the not-so-fun stuff, like when a company has to repay a grant. What happens then?
Yes, the repayment scenario. Not the most pleasant topic, but definitely important. Sometimes those free money strings can come back to bite you.
Because those conditions we talked about earlier can come back to haunt you. Yikes.
Exactly. And when that happens, IAS 20 says you need to treat it like a change in accounting estimate. Basically, you go back and adjust your books to reflect that you're no longer entitled to that grant.
So it's like a retroactive adjustment?
Precisely. And how you handle it depends on whether it was a grant related to income or a grant related to an asset.
Okay, let's break those down.
For a grant related to income, you first check if there's any unamortized deferred income related to that grant. If there is, you apply the repayment against that balance.
So you're essentially reducing that future benefit you were expecting.
Right. And if the repayment is more than the deferred income, or if there wasn't any deferred income to begin with, you recognize the entire repayment as an expense in the current period.
That's got to sting a bit. What about grants related to assets?
In that case, you increase the carrying amount of the asset or reduce the deferred income balance by the amount you have to repay.
So you're basically reversing the original benefit.
Exactly. And on top of that, you also need to recognize the additional depreciation that would have been taken if you hadn't received the grant in the first place.
Ouch. So it's a double whammy.
It can be, yes. And you also need to consider whether the repayment might trigger an impairment test on the asset.
Impairment test. That sounds serious. What's that all about?
Essentially, it's a check to see if the carrying amount of the asset is still higher than its recoverable amount. If it is, the company may need to write down the value of the asset,
Hmm.
which would be another hit to their profit and loss statement.
Okay, so repayments can get pretty complicated and have some serious financial consequences. But hang on a sec. IAS 20 doesn't just stop at grants, does it?
You're right. Remember we said that government assistance is a broader category. Well, IAS 20 also says that companies have to disclose information about other forms of government assistance they've benefited from, even if it doesn't strictly qualify as a grant.
Like those mentorship programs or tax breaks we discussed earlier.
Exactly. Even if you can't put an exact RAND value on those benefits, it's still important to be transparent and disclose them in the financial statements.
So it's all about painting a complete picture of how the government is supporting a company, even if it's not a direct cash handout.
Precisely. Transparency is key for building trust and confidence in the financial markets.
Makes sense. We've covered a lot of ground here, from recognizing grants to dealing with repayments, and even those less obvious forms of government assistance. What are some key takeaways you want our listeners to walk away with?
Well, after this deep dive, I think our listeners will definitely understand that even though it might sound a bit dry at first, IAS 20 plays a massive role in making sure things are fair and transparent in the financial world, both here in South Africa and globally.
It's like the referee making sure everyone's playing by the rules.
You know what's really interesting, though? IAS 20 isn't just about numbers and spreadsheets. It actually connects to bigger conversations about how our economy works, the role of government, and even fairness in the business world.
Okay, now you've really got me thinking. How so?
Think about it. When a company gets a grant, they're getting a boost from the government. That can be a game changer for small businesses, startups, or companies doing important work in sectors the government wants to promote.
Like those renewable energy projects we talked about earlier. Definitely makes sense.
Right. But it also raises some important questions about who's actually benefiting from these grants and if they're being used effectively. Are they really helping to create jobs and boost our economy, or are they just ending up in the pockets of a select few?
Those are some heavy questions, and I bet there are different opinions on this, depending on people's political views.
Absolutely. You'll find folks who believe that government grants are crucial for leveling the playing field and supporting industries that are vital for our society. Things like healthcare education or green technology. Things that might not be super profitable for private companies to invest in on their own.
It's like giving them a little nudge to do what's good for everyone.
Exactly. But then you'll have others who argue that too much government involvement can mess things up, create inefficiencies, and even lead to favoritism, where only certain connected companies benefit.
Ah, the classic debate about the role of government. It's a tough one.
It is. But that's what makes this whole discussion so fascinating. IAS 20 gives us a framework for understanding how government grants are accounted for. But it also opens the door to these bigger conversations about how we want our economy to work.
And those are conversations we definitely need to be having, especially here in South Africa with all our unique challenges.
I couldn't agree more. Understanding IAS 20, even on a basic level, can equip us to participate in those conversations in a more informed and productive way.
Because knowledge is power. And this deep dive has definitely given us a powerful new perspective on the world of business, government, and how things work in our economy.
Well said. Who knows, maybe we've even inspired some future accountants or economists out there.
One can only hope. But for now, it's time to wrap things up. Thanks for joining us on this deep dive into the surprisingly relevant world of IAS 20.
It's been a pleasure. As always, it's been great chatting with you and exploring these complex topics.
And to our awesome listeners, a big thank you for lending us your ears. Remember, curiosity is the fuel for growth and understanding. So keep asking those questions, keep exploring, and keep tuning in to the Ndubo Knowledge Cast for more insightful deep dives. Until next time, stay curious, stay informed, and stay lekker and